Welcome to Investors Guide. Thank you so much for tuning in. We've got everything you need over the next half an hour to manage all of your finances without worrying about anything at all. There's also an email ID at the bottom of your screen. So if you have a question, you can get straight to it. Now, on the show this week, we'll start by figuring out how China affects your mutual funds and if you should be worried at all. In our product review, we look at the HDFC Mid-Cap Opportunities Fund. We help an NRI couple a little further on the show save for their children's future and build a retirement corpus. It's time for me to bring in Kumar, the CEO of Value Research. Dhirendra, thank you so much for coming in.
Thank
you.
Of
course, there was a fair amount of volatility in our market, given what was going on with China. But the focus that I want to take is the three funds that we have in our market that focus on China specifically. See, these are funds that invest in China. There's a JP Morgan, a Mirae Asset, and a Goldman Sachs fund. Altogether, they have roughly about 100 crore rupees assets under management. These funds in the last 3 months came down between 11 and close to 20% between the three of them. And you've always maintained that as Indian investors, we should stay away from a fund that specifically looks at a geography. And you've told us to constantly invest in the two US domicile funds, which is the Franklin US Opportunities and the Motilal Oswal Nasdaq 100. Both of those funds have done really, really well over the same period. Does this particularly prove your theory that investing in an emerging market, focusing on a specific market, given the way that everything is cyclical right now, is not a great idea?
The whole objective should be to diversify and thereby reduce your risk and diversify in a manner which is meaningful. And that meaningful diversification will come only from a fund which is investing all over, or investing in a fund where and the underlying companies have global businesses. And from that standpoint, US funds, though domiciled in US, they look like a narrow geographic focus, but they are actually not, because the underlying companies have their global businesses. So that should be the focus of an Indian investor when he's investing in any international fund. And particularly about China fund, I don't think it makes sense for Indian investors, simply because, investors looking for growth, there will be a home bias, and you understand these funds much better. The taxation advantage that you have with an Indian fund and the character of Indian or Chinese market could be quite similar when looked from a global perspective. So from that standpoint, I don't think for an Indian investor investing in China fund to diversify or reduce their risk makes sense.
So Dhirendra, then if we have, let's assume like any other investor who writes in to us, I have about 10,000 rupees or 15,000 rupees going into mutual funds as SIPs every month. What portion of that should go into an international fund? And should I just keep that choice down to the two that you've already recommended on the show?
If an investor is appreciative of the fact that he wants to have a part of his portfolio in a fund which is globally competitive, businesses and global businesses as well, yes, those investments will make sense. Because all our jobs are in India, so and then our investment is in India, all our assets are in India. So from that standpoint, de-risking yourself to some extent can be achieved with that investment. But that doesn't mean that you should be making an investment which does not perform, but diversification for the sake of it does not make sense. The investment also must have the performance framework very nicely in place. And that seems, well in place with these two funds.
All right, I'm going to put those funds again on your screen. We're talking about the Franklin India Feeder US Opportunities Fund and the Motilal Oswal Nasdaq Top 100 Fund. Remember, both of these funds over a period of 3 years, 1 year, 3 months have outperformed the rest of the category of international funds altogether. Dhirendra recommends that if you want to diversify your portfolio from the Indian market, a small portion of the money that you're investing on a monthly basis should be in one of these funds. All right, let's move on to our portfolio question. A 34-year-old Ajit has written in, Dhirendra. He has an income of 55,000 rupees a month. His aim is to create a corpus for the usual child's marriage, his own retirement, a home in the future. He has a term insurance policy, which is a check. He has a good health insurance policy as well, and an emergency fund of 1.5 lakh rupees. So he's checked all of those boxes for us, and that makes us happy. He has a PPF of 30,000 rupees a year. I'm not sure if that's a good idea, considering there's also an EPF account. And mutual funds that he's sent in. He sent in the list. iProof Focus Blue Chip, HDFC Mid-Cap Opportunities, IDFC Premier Equity, UTI Dividend Yield. Now, the last two I'm a little worried about, Reliance Pharma and Reliance Gold Savings. So other than these two funds on his list, Dhirendra, he does seem to have taken our advice on the rest of his portfolio. Would you give him at least one thumb up on all of this?
Yes, I agree with you. Except for the last two funds, which he should not have in his portfolio. Rest of it is fine. And even about that, the pharma fund, it turns out to be that, it's extremely difficult to persuade an investor in a pharma fund because it has been able to build a performance through a long market cycle. But let me just remind you that a narrow sector fund like this, it does well. Last 5-7 years, the market has been of a kind where the FMCG and pharma funds have done well. But think of a situation, when a phase like 2004 to 7, that's the kind of phase which every investor waits for. When that time comes, they go completely out of favor, and maybe we might be very close to a stage of the market where things could be in for a turnaround, and pharma funds will not disappoint you. But compared to what? Compared to other parts of the market, they can be very disappointing. They will not generate negative return.
He also wants to ask you about the UTI dividend yield fund. He says it hasn't been performing well, so should he continue to hold that fund? And if I remember correctly, you put a sell call on this fund about 6 odd months ago when you said that you'd waited too long, you're not happy with the way things are going. Does that sell call remain? Would you recommend that Ajit also exits the UTI dividend yield fund?
Yes, the dividend yield as a strategy, has not done well. Most other funds of similar kind have struggled, but so has and UTI dividend yield has struggled a bit more. But I think it's about time that the tide will turn for this strategy, and high-yielding stocks and the overall complexion of the market makes me think that they are unlikely to be disappointing for very long from here on. So I would say that. If you are really for the long haul, then it may not be, definitely UTI dividend yield fund is not the finest dividend yield fund available. So from that standpoint, yes, it is worth considering switching it with some other option.
Would you very quickly give him another option, Dhirendra?
Get into any mainstream fund which can actually change track. Something like UTI equity could be a good substitute, and the way he's spread his investment, he has exposure to various skills.
All right, UTI equity on your screen right now. So a couple of things for you to think about. Consider very carefully whether you want to continue that PPF investment. Your money would be far better served in the mutual funds that you looked at. Dhirendra giving you a thumbs up on everything else in your portfolio, except that the gold fund and the pharma fund ideally would like you to exit those funds, and UTI dividend yield can be replaced with UTI equity. Well, Dhirendra, one very quick question before we go into break. Samrant Mohan has written in. He'd like to put aside 5 or 10,000 rupees every month in mutual funds with a 15 or 20-year horizon. So he wants you to recommend a couple of funds he can invest in. My hunch tells me that he's a first-time mutual fund investor because he tells us that he has 1.5 lakh rupees going into his PPF and he has an LIC Jeevan Anand policy. These are his only other two investments he has right now. I'm not happy with the both of them. But we don't know what the rest of his portfolio looks like. Does he have an EPFO deduction as well? He hasn't told us. What would you recommend he does?
It entirely depends on his tax situation. If he is a taxpayer and he needs to avail that 1.5 lakh going into PPF, then he should start with his PPF immediately getting diverted to a tax-saving fund or an ELSS. And remaining money must find its way into, given the kind of investor he is, he should seriously consider discontinuing his PPF account, at the same time planning his withdrawal from Jeevan Anand and moving all that money into a balanced fund and being regular with it. His return will be substantially more. One should not be mixing investment and insurance, and before all this he should estimate his term insurance, his insurance cover requirement and buy a term plan.
So remember, buy a health insurance policy as well. And Dhirendra, they're saying that you must have a term insurance cover and a mutual fund. It will serve you better than the Jeevan Anand policy. Dhirendra, two funds that you'd like him to start his mutual fund portfolio with. Would you like to use our stable growth portfolio?
Yes, choosing one or two funds for the long term, I think, consider Tata Balanced or Franklin Balanced Fund. That could be, or one or two funds from our stable growth portfolio. That should be good enough.
All right, on your screen right now is our stable growth portfolio. Pick one or two funds and you should be comfortable using them. Coming up after the break, Dhirendra will stay with us. We'll review the HDFC Mid-Cap Opportunities. Take a look at the stellar performance. That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide in ET now. Thank you for staying with us. It's time for us now to review the fund of the week. This week we're looking at HDFC Mid-Cap Opportunities. Avan will take you through the numbers and then we'll come back and talk to Dhirendra about it. Avan.
Thanks, Faye. The fund in focus this week is the HDFC Mid-Cap Opportunities Fund. With over 10,870 crores of assets under management, it is the second largest fund in its category. The fund has delivered stellar returns ever since its launch in the year 2008. But how does its performance look in the recent past? A close look at the fund's performance chart over the last 5 years shows that it has performed better than its peers in both the bull and the bear phases of the market. You'll see that the red line, which is the fund, has consistently outperformed its category and its benchmark, the CNX Mid-Cap. The fund was at its best when compared to its peers in the year 2013, generating a return of 10%. The trailing return of the fund shows that it performed better than its category in the 1, 3 and 5-year periods. You'll see that despite lagging behind some of its peers by a margin in the last 1 year, it has outperformed them in the long term, making it apt for long-term investors. So is this a fund a must-have in your portfolio? Let's find out. With that, back to you, Faye.
Well, Dhirendra, HDFC Mid-Cap Opportunities has been such a stellar performer, especially over the last 1 year. Does it go down in your book as a mid-cap that any sort of mid-cap investor must consider having?
Yes, it's an outstanding mid-cap fund, and it has done very well. But so have, if you just go by performance in last 1 year, 1.5 years, there'll be many other mid-cap funds which have done much better than HDFC Mid-Cap Opportunity. But I still like this fund. Of course, the odds are getting stacked, and I would say that this is a relatively conservative mid-cap fund, either being forced to be one, or also given its quality focus. So I don't know how it will pan out over a period of time, but on a full market cycle, this fund should prove to be very rewarding.
Well, Dhirendra, this is, the question about mid-cap funds, the fact that there will be volatility, the fact that it will make an investor nervous. If I were to invest in HDFC Mid-Cap Opportunities, A, what sort of volatility should I be prepared for? And what kind of time horizon should I ideally have for a fund like this? I
would say that just recall 2008, and this fund was down 54% in a 1 year phase. So things can turn out to be very bad when it comes to when you are faced with a very difficult market or a lean market for a prolonged period of time. But I would say that is where this fund actually stacks up very nicely. It's quality focus, and now it's a 10,000 crore, and it's pretty large for a mid-cap fund. It is forced to be into relatively larger mid-caps. So, and the portfolio of 10,000 crores spread over 74 stocks as of last month end, it forces the fund to be in relatively larger companies. It actually has kept away from the micro cap, so to say. Think of it as a conservative mid cap. It is unlikely to give you very nasty surprise.
All right, Dhirendra, finally your rating of the HDFC Mid-Cap Opportunities Fund on Investors Guide, where would you place it?
Scared investors still getting tempted to invest in HDFC Mid-Cap Opportunity. I think it's a 5-star fund because it's quality focus, and I think that matters in the long run. In a full market cycle, being in a stock which will not disappear, which will not stop trading, that I think should be is something which investors forget in good times.
All right, so that's the HDFC Mid-Cap Opportunities on Investors Guide. If you have a question about that particular fund, write to us on the email ID. It's at the bottom of your screen. Dhirendra, let's quickly breeze through our hold or sell segment. 29-year-old Biswajit has written in from Bangalore. He's been investing 10,000 rupees in mutual funds from May this year, and he wants to buy a car, he says, of 8 lakh rupees in the next 3 years and build a corpus of 20 lakh rupees for a home in the next 6 years. That might be a bit of an ask if he's planning to take that 8 lakh rupees out of his portfolio, a couple of years down the line. But here are his funds, Dhirendra. And the reason why I've picked them is because they're an interesting list of funds that we don't normally see in portfolios. First up is the Franklin Build India Fund. Now, given everything that, the government has on its agenda in terms of, building infrastructure and building roads and building homes, this might seem like an interesting, theme to go with. But would you recommend he stays away from the theme entirely?
No, I think one should keep away from such things. The reason being that an investor's perspective or the way to approach such thing is that you hire a great fund manager who will do the job for you. You don't hire a fund manager and tell him that you just have to do this. And that is what has happened with the infrastructure fund, or this, we can call this Build India fund as a quasi-infrastructure fund. It might have a loose mandate and it can invest elsewhere too, but that's broadly the theme. And from that standpoint, I think it's a constraint. And it has been disappointing. Time and again, we are getting a signal that it's poised for a takeoff. It's about to turn around, but the reality turns out to be different. Unless many of these companies are able to get rid of their debt, they are very heavily indebted. Unless we see ground realities changing. There isn't a reason why, just because it has been talked about for so long, and there is a possibility that things will turn around. But I don't see any reason why an investor should be there, because think of any other general fund an investor will be investing in, and that is the fund manager's responsibility to be into such stocks as well, as and when it is opportune, and keep away from them as and when. So I think it's a constraint. One should not be investing in such thematic funds for that reason.
He also has the Kotak Select Focus Fund and the UTI MNC Fund, Dhirendra. What would you recommend on both of these funds?
I would say that the MNC fund, because of a certain kind of companies not being there, it has done well and it has gained investors' attention. But for the same reason, that it's little constrained portfolio. In fact, here is a fund which will not be able to invest in any of the infrastructure companies because we don't have too many of them here. Likewise, certain sector which are completely out of the MNC framework. So that is again an unnecessary constraint. And Kotak Select Focus is a promising fund managed by a it's managed by a very experienced and a credible fund manager. So be at it. That's a kind of fund which can deliver you superior return and make the most of a rising market.
The last two funds on his list is the Axis Long-Term Equity and the BNP Paribas Equity Fund. Dhirendra, continue with both of these investments?
Yeah, absolutely. They are outstanding fund. In fact, Axis Long-Term Equity is a tax-saving fund, and maybe why invest just 1,000 rupee? Invest more so that you are able to avail as much as you can in Section 80C with this fund.
Here's one last question for you, Dhirendra. He has about 2,000 to 5,000 rupees that he can add every month, and he wants to know what he should add to this portfolio. His question is, should it be a debt fund or should it be another equity fund? What would you recommend he does?
It's entirely a matter of some of his spending plans. If he plans to buy his car, then and in next 1 to 2 years, then that's the money which can well be in a short-term debt fund, which will be earning less, but it is unlikely to give him any surprise. And he will be very aware, he will get fairly predictable return. If he has little more time, then he should approach it differently. And if that all the money is for the long term, then he has built a good portfolio. I don't think he should be adding any more, just increase the amount of investment going into respective funds.
All right, Dhirendra, many thanks for joining us on the show.
Thank you.
On Investors Guide this week, we look forward to having you back again next week. Remember, any question you have to ask Dhirendra Kumar, this is the best way to do it. Write to us on the email ID at the bottom of your screen. Coming up after the break, we answer questions from NRIs who want to start investments in India and who want to build their retirement corpuses. That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. It's now time to answer all the questions you sent in on your asset allocation. And Ashish Shankar joins in. He's the head of investment advisory from Motilal Oswal Wealth Management. Ashish, thank you for joining us. Welcome to Investors Guide.
Thank you very much.
This is Ashish's first time on the show. Ashish, our first question comes in from Venkata Mahesh. Now, he's been investing in mutual funds for the last 5 years, and he tells us he's not entirely satisfied with the returns. Now, these are the two funds he's investing in, the ICICI Prudential Dynamic and the IDFC Premier Equity Fund. And I'm surprised he's finding them unimpressive because they're both stellar performers. He wants you to suggest a couple of funds in the same category for a 5-year horizon. Now, first of all, Venkata, I want to remind you that these are great funds. So take a look at the returns on those funds one more time. Compare them to peers. Compare them to other funds that do the same thing. And you'll see that they've been very, very good performers. But if he still really insists on switching up, Ashish, could you help him out with some more names?
Typically what happens is that the ratings of funds keep changing from a 3 to 4 year perspective, as every rating company has its own criteria. I would recommend you to switch to ICICI Approved Discovery Fund within the same fund house, because I believe that from a longer term perspective it will do very well. The other funds that you can add are Franklin India High Growth Fund, and you could also look at the Motilal Oswal Focus 35 Fund. These are fund houses which have very good long-term track records and should give you good returns in the long run.
Our next question comes in from Anbar Hassan. He wants to begin investing in mutual funds using an SIP with a moderate risk profile. He has an 8 to 10 year horizon, and that's always nice to hear. He wants us to help him with a couple of funds to start off with. Now, if it's his first investment, I would like him to start off maybe with a balanced fund. What would you recommend, Ashish?
From a medium term to long term perspective, given that you're looking at funds which have moderate risk, I feel balanced funds can add a lot of value to your portfolio. The three top balanced funds that we would recommend are Tata Balanced Fund, Franklin India Balanced Fund, ICICI Approved Balanced Fund. I believe that balanced funds will give you a good combination of debt and equity. Typically these funds have 65 to 75% in equities, and remaining portion is invested in debt. So given your 8 to 10 years horizon, equity should deliver the maximum returns, and the debt portion gives stability in volatile markets. So I would recommend that you should look at balanced funds for doing your SIPs.
All right, last question on the show comes in from an NRI living in Dubai. 32-year-old Manishankar Shukla has written in. Now, he tells us he's been investing 75,000 rupees a month in mutual funds for the long term. He and his wife want to save for their child and build a retirement corpus for when they move back to India. He's picked the HDFC Growth Fund, the DSP BlackRock Tax Saver, HDFC Top 200. Now, he'd like to add another investment of 5,000 rupees. Where should that investment go? Ashish?
So, given the fact that you're looking at investing about 5,000 rupees a month in 5 different funds, my advice would be not to look at more than 3 funds, as over diversification also leads to lower returns. I would advise that you should stick to 3 well diversified funds which can give you decent growth over a period of time. The 3 funds that I would recommend are the Motilal Oswal Focus 35 Fund, the ICICI Approved Discovery Fund, the Franklin High Growth Companies Fund, and in case you want to add a 4th fund, I would suggest the Reliance Equity Opportunities Fund. But I would feel that 3 funds are more than sufficient to cater to your requirement of saving on a monthly basis.
All right, that's a wrap on Investor's Guide. Ashish, it was a pleasure to have you on the show. We must have you back again very soon.
Thank you
Remember,
very much.
if you're watching at home and you have a question about a loan or about an investment or simply about saving money, you can always write into us. Our email ID is at the bottom of your screen. A copy of this show will be available on our Facebook page, and you can reach me personally on Twitter. I love hearing from you. Tune in next week and catch Investor's Guide. Thanks for watching.